The night everything changed, it was just after 1 in the morning on June 24, 2021, when the world shifted for hundreds of families in Surfside, Florida. Most people were asleep, wrapped in the comfort of their homes, never suspecting that the ground beneath them was about to give way. Without warning, revealed the east wing of Champlain Towers South, a 12th-story condominium perched just steps from the ocean, suddenly collapsed. In a matter of seconds, what had been a symbol of coastal living turned into a scene of chaos and heartbreak. Concrete thundered down, crushing homes, dreams, and lives. Revealed 98 people lost their lives before the sun even rose, and the shockwaves from that night would ripple far beyond the city limits of Surfside. For years, revealed, Florida's beachfront condos had been sold as a slice of paradise. The promise was simple ocean views, warm breezes, and a safe, affordable place to retire or raise a family. But as the dust settled over the ruins of Champlain Towers South, a terrifying truth emerged. Safety was never guaranteed. The collapse wasn't a random act of fate. It was the final chapter in a story of warnings ignored, repairs delayed, and problems hidden just out of sight. Engineers and investigators would later reveal that the building's decline had been visible for years. Cracks in the concrete, rust spreading through steel, water seeping into the garage. These were not secrets, but signs that had been documented and debated long before disaster struck. In 2018, consultants had warned the Condo Association about the urgent need for repairs. Revealed, the price tag was steep, between $9 and $15 million. Owners argued over who should pay, and the work was postponed again and again, every year. The building grew weaker, but the illusion of safety held firm. That illusion shattered in the early hours of June 24th. The collapse didn't just destroy a single building. It exposed a hidden crisis lurking beneath the surface of thousands of aging condos up and down Florida's coast. As news of the tragedy spread, fear took hold in communities that had always felt secure. Residents in similar towers began to wonder if their homes might be next. Night after night, people lay awake, listening for sounds they'd never noticed before. The creak of a balcony, the drip of water, the distant hum of elevators. Suddenly, every crack in the wall or patch of rust felt like a warning. The comfort of home was replaced by a gnawing sense of uncertainty. The Surfside disaster forced everyone to ask the same haunting questions: how could this happen? And if it happened here, could it happen anywhere? The answers were unsettling. Investigators found that the problems at Champlain Towers South weren't unique. Across Florida, decades of deferred maintenance, financial shortcuts, and patchwork repairs had left countless buildings vulnerable. The state's rapid growth in the 1970s and 1980s had produced a boom in condo construction, but many of those towers were now showing their age. Salt air, hurricanes, and relentless sun had taken their toll, and the cost of keeping these buildings safe had been quietly mounting for years. For the families who lost loved ones, the pain was immediate and unimaginable. But for thousands of other condo owners, the tragedy marked the beginning of a new kind of fear, a fear that their own homes might be hiding the same deadly flaws. The collapse became a wake-up call, not just for Surfside, but for the entire state. Suddenly, the dream of affordable coastal living was under threat, and no one could say for sure what would come next. In the days that followed, the world watched as rescue crews searched the rubble, hoping for miracles that never came. The images of twisted steel and shattered concrete were broadcast around the globe, a stark reminder of how quickly everything can change. But beneath the headlines, a quieter crisis was unfolding. Condo associations scrambled to review inspection reports, engineers were called in to assess hidden damage, and owners braced for the possibility of massive repair bills. The sense of security that had defined Florida's condo lifestyle was gone, replaced by anxiety and doubt. Rumors began to swirl online and in community meetings. Some speculated that other buildings might be at risk, pointing to reports of cracks, leaks, and corrosion in towers from Miami Beach to Naples. Revealed. Others questioned whether local officials had done enough to enforce safety standards, or if years of lax oversight had allowed problems to fester. The truth was complicated, but one thing was clear: the collapse at Champlain Towers South had exposed a system that was broken, and the consequences were only beginning to unfold. For many, the most chilling realization was that the warning signs had been there all along. Residents remembered meetings where engineers described urgent repairs, only to see the work delayed by arguments over cost. Some recalled seeing water stains in the garage or hearing about rusted rebar beneath the pool deck. In hindsight, these details took on a new and terrifying significance. The tragedy wasn't just a freak accident. It was the result of years of decisions, each one pushing the building closer to the brink. As investigators sifted through the debris, lawmakers in Tallahassee faced mounting pressure to act. The public demanded answers, and the state's leaders promised that nothing like this would ever happen again. But for the people living in Florida's aging condos, revealed the damage was already done. The night everything changed had left a scar that would take years to heal, if it ever did. The collapse of Champlain Towers South was more than a single disaster. It was a turning point. It shattered the myth of guaranteed safety and forced an entire state to confront the hidden risks lurking in its most iconic buildings. In the months and years that followed, the fallout would reshape Florida's coastline, upend the lives of thousands, and ignite a crisis that no one could ignore. But as the dust settled and the headlines faded, one question remained: if it could happen in Surfside, where else might the ground give way? The new laws that changed everything. In the wake of Surfside's devastation, Florida's lawmakers faced a tidal wave of outrage and fear. The collapse had exposed not just the fragility of one building, but the vulnerability of an entire way of life. Suddenly, the state's sun-soaked coastline, once a symbol of carefree living, was under a harsh new spotlight. The public demanded action, veiled, and Tallahassee responded with a sweeping set of reforms that would upend the condo world as everyone knew it. Within a year, the rules for every condominium in Florida changed almost overnight. No longer could associations rely on hope, luck, or the old habit of kicking the can down the road. The new laws were strict, detailed, and, most importantly, enforceable. For the first time, safety wasn't just a suggestion. It was the law, and the clock was ticking. The centerpiece of the reform was the milestone inspection mandate. Every condo building 3 stories or higher would now face a rigorous structural review at the 30-year mark, or at just 25 years if it stood within 3 miles of the coast. For thousands of towers built during the 1970s and 1980s, that deadline had already come and gone. Suddenly, revealed, buildings that had coasted for decades were thrust into the spotlight, forced to prove they were safe or face the consequences. The inspection process itself was a 2-phase ordeal. Phase 1 started with a visual sweep, engineers scouring every inch for cracks, rust, and spalling concrete. Revealed. If they found signs of trouble, Phase 2 kicked in, drilling deeper with core samples and load tests to uncover hidden weaknesses. In coastal zones, where salt air and storms had battered buildings for years, passing on the first try was rare. County records soon revealed a sobering truth. Up to a quarter of older buildings needed immediate follow-up investigations, and some were flagged as unsafe on the spot. But the new laws didn't stop at inspections. For the first time, every condo association was required to maintain fully funded reserves for structural repairs, roofs, and critical systems. The old system, where owners could vote each year to skip or slash reserve contributions, was gone. Now, associations had to collect enough money to cover the real cost of major repairs, with no exceptions and no more wishful thinking. The law spelled out exactly what had to be covered: the foundation, exterior walls, roof, plumbing, electrical, fire safety, and elevators. Reserve studies had to be completed, and the required funds set aside, not just promised on paper, but actually in the bank. The deadlines were absolute. December 31, 2024, became the line in the sand. By that date, every Florida condo association with buildings 3 stories or higher had to comply, or face steep penalties. In some cases, failure to act could mean the building would be declared unsafe, forcing residents to leave their homes. For associations near the coast, the rules were even stricter, and extensions were rare. Revealed. Local officials had the power to condemn buildings that missed deadlines or failed to fix critical problems, and some didn't hesitate to use it. The impact was immediate and dramatic. Boards that had once debated repairs for years were now forced to act, often issuing capital calls for tens of thousands of dollars per unit. Whether owners could afford it or not, the bills had to be paid. The goal was cleared. When the next critical repair was needed, the money would be there, No more gambling with people's lives. But for thousands of buildings with aging infrastructure and years of deferred maintenance, meeting the deadline triggered a financial reckoning that few had seen coming. Special assessment letters began landing in mailboxes across Florida. Some demanded $10,000 per unit, others $50,000, $100,000, or even more. In older coastal buildings, the numbers climbed higher still, with a handful of towers near Miami Beach and Naples seeing bills top $200,000 per owner. The assessments covered urgent repairs, concrete restoration, new roofs, upgraded fire alarms, elevator overhauls, and, for the first time, fully funded reserves. For many owners, the math was impossible. People who had paid $150,000 to $300,000 for their condos now faced assessment demands that rivaled or exceeded their original purchase price. Association board records from across the state tell the story of what happened next. Meetings grew heated, with owners packing into rooms to debate how to pay bills that seemed impossible. In Fort Lauderdale, one building's minutes detail a 4-to-3 split over a $95,000 per unit assessment. In Naples, negotiations broke down after a proposal for a 7-year payment plan was rejected out of concern for lenders. Emails and court filings document owners slashing grocery budgets or skipping medications to scrape together payments. Others simply walked away, unable to pay or sell. For retirees on fixed incomes, the shock was immediate and devastating. The dream of a quiet retirement by the sea had turned into a nightmare of bills, stress, and uncertainty. But the new laws were unyielding. Compliance wasn't optional, and the penalties for falling short were severe. Buildings that failed inspections or couldn't fund repairs faced fines, legal action, or even condemnation. Local officials, under pressure to prevent another Surfside, enforced the rules with new urgency. Some buildings were declared unsafe, and families were ordered to leave with just days' notice. The message was clear: safety came first, no matter the cost. The reforms also changed the way insurance and financing worked for condos. Lenders and insurers now demanded proof of compliance, fully funded reserves, up-to-date inspections, and no pending structural repairs. Without these, banks refused to issue mortgages, and insurers pulled out of the market, leaving associations scrambling for coverage. The financial system that was supposed to protect owners now became another source of pressure, locking thousands of people in place. For many, the new laws felt like a double-edged sword. On one hand, they promised to prevent another tragedy, forcing associations to confront problems that had been ignored for too long. On the other, they triggered a wave of financial pain that swept through middle-class buildings, longtime residents, and anyone caught in the path of compliance. The numbers left no room for denial. Decades of deferred maintenance had come due all at once, and the bill was staggering. As the December 2024 deadline approached, the sense of urgency only grew. Boards raced to complete inspections, raise funds, and avoid the threat of condemnation. Owners braced for more assessments, higher fees, and the possibility that their homes might become unsellable. The dream of affordable coastal living was slipping away, replaced by anxiety and a growing sense of crisis. The new laws that changed everything were born out of tragedy, but their impact reached far beyond safety. They forced Florida to confront the true cost of its coastal lifestyle, exposing the hidden risks and financial burdens that had been building for decades. For thousands of condo owners, the reforms were a wake-up call, a reminder that paradise comes with a price, and that ignoring problems only makes them worse in the end. But as we'll see, the financial shock was just the beginning. The next wave of the crisis would hit even harder, as insurance premiums soared, lending dried up, and the market for Florida condos began to unravel in ways no one could have predicted. The financial avalanche, the ink was barely dry on Florida's new condo safety laws when the first wave of financial shock hit. For years, the owners had been told that repairs could wait, that costs could be managed, that the dream of affordable coastal living was still within reach. But as the new mandates took effect, that illusion crumbled. Suddenly, the true price of decades of deferred maintenance and financial shortcuts came due all at once. And the numbers were staggering. It started quietly, with letters arriving in mailboxes across the state. At first, some owners thought it was a mistake, a typo, maybe, or a miscalculation. But as they read the details, the reality set in. These were special assessment notices, and the amounts demanded were unlike anything most had ever seen. In some buildings the bills were $10,000 per unit, in others $50,000, $100,000, or even more. In the most troubled towers along Miami Beach and Naples, the number soared past $200,000 per owner. For many, the assessment was as much, or more, than they had originally paid for their homes. The shock was immediate and widespread. In communities built on the promise of affordable retirement, the financial avalanche hit hardest. Retirees who had saved for decades, who had paid off their mortgages and planned to live out their days by the sea, suddenly faced bills they could not possibly pay. Some slashed their grocery budgets, skipped medications, or dipped into emergency savings just to keep up. Others simply gave up, walking away from homes they had cherished for years, unable to sell or refinance in a market that had turned against them overnight. Association board records from across Florida tell the story in stark detail. In Fort Lauderdale, one building's minutes describe a 4-3 split over a $95,000 per unit assessment. The debate was heated, with some owners pleading for more time, others demanding immediate action to avoid condemnation. In Naples, a proposal for a 7-year payment plan was rejected after lenders warned it would jeopardize financing for the entire building. Emails and court filings reveal the desperation behind the numbers. Owners begging for relief, threatening lawsuits, or simply resigning themselves to the inevitable. The financial avalanche didn't discriminate. It swept through luxury towers and modest buildings alike, hitting longtime residents and newcomers, the wealthy and the middle class. For some, the assessment was a temporary setback. For others, it was a life-altering blow. The math was brutal. A $150,000 condo with a $100,000 assessment was suddenly worth less than nothing. Owners who had once seen their homes as a nest egg now faced the prospect of losing everything. The stories behind the numbers are heartbreaking. Maria, a retiree in Naples, received a letter demanding $120,000 for structural repairs, a new roof, and reserve funding. Her fixed income barely covered groceries and medicine, let alone a 6-figure bill. She tried to sell, but buyers vanished as soon as they saw the assessment. "I've started skipping meals," she wrote to her board. "I don't know what else to cut." In Fort Lauderdale, James watched as his building's board split over an $18 million restoration plan, leaving some owners facing assessments that exceeded the value of their condos. When insurance flagged structural hazards, the building's master policy was set to expire, and county officials declared 13 units uninhabitable. Families were ordered to leave, not knowing if they'd ever return. The avalanche didn't just hit individuals. It tore through entire communities. In buildings where owners walked away or defaulted, those left behind faced even bigger bills. Monthly HOA fees doubled or tripled as the pool of paying residents shrank. Basic maintenance slipped, elevators broke down, roofs leaked, and common areas grew shabby. Residents gathered in lobbies and laundry rooms, trading stories of skipped meals and canceled trips, wondering how it had all gone so wrong. The financial pressure was relentless. For many, the condo was their only major asset. Bought for $200,000 or less in the 2000s with no mortgage and the hope of aging in place. That security vanished almost overnight. Selling wasn't an option when buyers wouldn't touch units burdened by massive pending assessments or uncertain repair costs. Foreclosure loomed for those who couldn't pay, but walking away meant losing everything. The dream of a quiet retirement by the sea had become a nightmare of anxiety, isolation, and a sense of being forgotten. The avalanche also exposed deep divisions within communities. Board meetings dissolved into shouting matches over assessment fairness, payment timelines, and whether repairs could be delayed. Some owners accused boards of acting too slowly, pushing for emergency action to avoid condemnation. Others alleged breach of fiduciary duty, filing complaints that boards acted without proper notice or transparency. Court dockets show a surge in filings. Owners challenging assessments, contesting election results, or seeking injunctions to halt repairs. Some buildings now spend more on legal fees than on actual maintenance, trapped in a cycle of gridlock and blame. The financial reckoning triggered by the new laws was supposed to make buildings safer, but for many, it brought only hardship and uncertainty. The numbers left no room for denial. Decades of deferred maintenance had come due all at once, and the bill was staggering. the financial avalanche was more than just a series of big numbers on a page. It was a human crisis, reshaping lives, communities, veiled, and the very idea of what it meant to live on Florida's coast. But as devastating as the special assessments were, they were only the beginning. The next wave of the crisis would come from a direction few had anticipated. As insurance premiums soared, coverage vanished, veiled, and the cost of simply keeping a roof over your head reached new and unimaginable heights. The lending freeze. If the insurance meltdown was a storm, the lending freeze was the deep freeze that followed, locking thousands of Florida condo owners in place and turning the dream of a quick sale or easy refinance into a distant memory. For decades, the ability to buy, sell, or borrow against a condo was almost taken for granted. Banks, mortgage companies, and government-backed lenders like Fannie Mae and Freddie Mac had always been eager to finance Florida's coastal lifestyle. But after Surfside, everything changed. The rules were rewritten, the standards tightened, and suddenly, the financial lifeblood of the condo market began to dry up. It started quietly, with new memos and policy updates circulating among lenders in late 2023. Fannie Mae and Freddie Mac, the giants of the mortgage world, announced sweeping changes to their lending criteria for condos. No longer would a building's age or location be enough to secure a loan. Now, every application required proof of fully funded reserves, up-to-date milestone inspections, veiled, and, most critically, no pending structural repairs or special assessments. If a building failed to meet even one of these requirements, the answer was simple: no loan. Banks and credit unions quickly followed suit, issuing their own internal guidelines that flagged any building with open assessments, lapsed insurance, or incomplete reserve studies as high risk. Title companies joined in, refusing to issue policies for units in non-compliant buildings. The result was immediate and dramatic. Applications that would have sailed through just a year earlier were now routinely denied, even for buyers with perfect credit and hefty down payments. The message was clear: if your building wasn't up to code, you were on your own. For owners, the lending freeze was a nightmare with no end in sight. Imagine trying to sell your condo, only to discover that no bank would finance the purchase. Not because of anything you did, but because your association couldn't prove it had enough money in reserves or had completed the latest round of inspections. Even cash buyers, once seen as a lifeline, became scarce, wary of taking on a unit in a building that might face massive assessments or insurance problems down the line. The market for older condos, especially along the coast, began to seize up. The numbers tell a stark story. Between October 2023 and February 2024, denial rates for condo loans in non-compliant buildings more than doubled. In Miami, Dade, and Broward counties, dozens of pending sales collapsed in a single month after lenders reviewed association budgets and inspection reports revealed. Mortgage servicers reported a surge in applications withdrawn or denied as buyers realized the hurdles were simply too high. Even owners hoping to refinance to pay their assessment bills found the door slammed shut. Without financing, units became illiquid assets, impossible to sell, impossible to borrow against, and, for many, impossible to keep. The impact rippled through every part of the market. Sellers outnumbered buyers by a wide margin, and properties lingered on the market for months. In some buildings, listings gathered dust as owners waited for a miracle that never came. Real estate agents described open houses with no visitors, price cuts of 20, 30, even 40%, and still no offers. The lending freeze didn't just slow the market, it brought it to a grinding halt. For many owners, the freeze was the final straw, revealed. Some had already weathered special assessments and soaring insurance premiums, only to find themselves trapped in a home they could neither afford nor escape. The stories piled up: retirees who needed to downsize but couldn't sell, families who wanted to move for work or school but found no buyers, and investors who watched their property values plummet with no way to cash out. Home sales revealed. The financial assault against another Surfside now locked thousands of owners in place, regardless of price or need. The lending freeze also exposed deep inequalities in the market. Newer buildings with up-to-date reserves and clean inspection reports continued to attract buyers and secure financing, especially in inland areas less exposed to saltwater and storms. But for the vast majority of older coastal towers, the freeze was absolute. No loan, no sale, no way out. The dream of affordable coastal living was replaced by a new reality, a market where only the wealthiest cash buyers could compete and everyone else was left behind. The consequences extended far beyond individual owners. As sales collapsed, inventory piled up. By 2024, Florida condo and townhouse sales had dropped to their lowest level since 2010, with months of supply more than doubling in some areas. Median prices slip, and in the hardest hit coastal counties, even dramatic discounts weren't enough to attract buyers. The lending freeze turned what might have been a temporary correction into a full-blown crisis, deepening the financial pain for thousands and threatening the stability of entire communities. The frustration and anxiety were palpable. Association boards scrambled to meet the new requirements, hiring engineers, updating reserve studies, and pleading with owners to approve new assessments. But for many, the deadlines were impossible to meet, and the costs were simply too high. Owners gathered in lobbies and community rooms, trading stories of failed sales, denied loans, and the growing sense that the system was rigged against them. Rumors and speculation filled the void left by official answers. Some owners wondered if the freeze was a deliberate attempt to drive out the middle class and pave the way for luxury redevelopment. Others blamed the banks, the insurers, or the state for creating a system with no escape hatch. What was clear to everyone was that the old rules no longer applied, and the path forward was anything but certain. The lending freeze was more than just a financial hurdle. It was a psychological blow. A daily reminder that the safety net had vanished and that the dream of coastal living now came with risks no one had imagined. For thousands of Floridians, the question was no longer how to thrive, but simply how to survive. And as the freeze continued, the crisis only deepened. The next chapter would reveal how the market collapse, legal gridlock, and political stalemate combined to leave owners and entire communities in a state of limbo, waiting for relief that never seemed to come. Market freefall, as the lending freeze tightened its grip and insurance costs soared. Florida's condo market began to unravel in ways that few could have imagined just a few years earlier. The state that once symbolized sun, sand, and the promise of affordable coastal living was now at the epicenter of a real estate crisis that seemed to have no bottom. The numbers told a story of collapse, but behind every statistic was a family, a retiree, or a lifelong resident watching their dreams slip away. By 2024, the data was impossible to ignore. Condo and townhouse sales across Florida had plummeted to just 94,000 units, a 10.5% drop from the previous year and the lowest total since 2010. Inventory piled up at a staggering rate, with 8.2 months of supply for condos and townhomes, more than double the 4.7 months seen for single-family homes. In practical terms, this meant that sellers outnumbered buyers by a wide margin, and properties lingered on the market for a median of 74 days, up 27% year-over-year. The once red-hot market had turned ice-cold. But the pain wasn't spread evenly. Coastal counties, Miami-Dade, Broward, Palm Beach, Collier, and Lee were at the center of the downturn. Here, the combination of looming special assessments, insurance woes, and lending restrictions created a perfect storm. Buyers, once eager to snap up a slice of paradise, now stepped back in droves, wary of the financial landmines hidden in older buildings. In Miami-Dade, sales of existing condos and townhomes dropped more than 14% from the previous year, with active listings outpacing closed deals by nearly 3-to-1. Broward County faced a similar reckoning, with hundreds of buildings scrambling to comply with new inspection and reserve rules, and buyers vanishing as quickly as the "for sale" signs went up. The numbers were even more brutal in Palm Beach County, where the beachside towers lining A1A saw months of supply surge above 10, and price cuts as deep as 40% still left units unsold. Collier County, home to Naples, reported the steepest price declines in 2 decades. Here, older beachfront buildings were stuck in limbo, with owners receiving assessment bills topping $150,000 and buyers disappearing even after dramatic discounts. In Lee County, which includes Fort Myers and Cape Coral, dozens of Gulf front towers now carried vacancy rates above 30%, with many units sitting idle as owners refused to pay new fees or simply walked away. In each of these coastal hotspots, the same pattern repeated: aging towers, rising costs, and a shrinking pool of buyers. Real estate agents in Miami Beach and Naples described open houses with no visitors and listings that gathered dust for months. County records confirmed that more than a third of all condo sales in these areas now closed at a loss, with some owners accepting offers 50% below their 2021 peak. The market correction was no longer a question of, but how far and for how long? Meanwhile, a different story was unfolding inland. The I-4 corridor, stretching from Orlando's suburbs to the villages in Ocala, bucked the trend. Here, newer construction and less exposure to saltwater meant fewer special assessments and a steadier flow of buyers. Months of supply remained below 5, and sale prices held firm. For these communities, the crisis on the coast felt distant, almost like a different world. But for the vast majority of Florida's condo owners, the reality was stark. The market had entered freefall, and there was no safety net in sight. The human toll of the market collapse was devastating. Maria, who bought her Naples condo at Saget East in 2009, received a letter in February 2025 demanding $120,000 for her share of structural repairs, a new roof, and reserve funding now required by law. Her fixed income covered groceries and medicine, not six-figure bills. She tried to sell, but buyers vanished once they saw the assessment. "Veal, I've started skipping meals," she wrote in an email to the board. "I don't know what else to cut." James, living in Harborview South, a 1981 tower in Fort Lauderdale, watched as his building's board split over an $18 million restoration plan. Vealed, leaving some owners facing more than their condos were worth. When insurance flagged structural hazards, the building's master policy was set to expire. Revealed, and county officials declared 13 units uninhabitable, ordering families to leave until repairs began. The stories multiplied. Elena, at Atlantica in Miami Beach, faced a $92,000 assessment and no way to finance a replacement home after her building's insurance was canceled. The elevators failed, the roof leaked, and mold crept down the hallways. "We're trapped," she told a reporter. "No one will buy, no one will lend. And all anyone talks about are lawyers and bankruptcy." 3 owners, 3 buildings, each facing a different version of the same crisis: bills they cannot pay, homes they cannot sell, and futures no longer in their control. The market freefall also had ripple effects far beyond individual owners. As values collapsed, so did the tax base that funded local schools, emergency services, and infrastructure. Broward County's budget hearing in July 2025 opened with a warning. Property tax projections were being slashed by $37 million for the coming year, not because of a hurricane or recession, but because of the collapse of condo values along the coast. Miami-Dade's finance office reported a $24.5 million drop in anticipated collections from beachfront condos, with the sharpest losses in North Beach and Sunny Isles. Palm Beach County faced an $11.2 million gap as condo values east of US 1 tumbled. These numbers, drawn straight from county budget minutes, revealed how the crisis was no longer limited to individual owners or buildings. It now threatened the fiscal health of entire communities. Revealed, the market freefall also exposed a growing divide between those who could weather the storm and those left behind. Wealthier buyers, often paying cash, began to circle distressed properties, looking for bargains or redevelopment opportunities. Meanwhile, longtime residents, retirees, and middle-class families found themselves locked out, unable to sell, refinance, or even keep up with rising costs. The dream of affordable coastal living was slipping away, replaced by a new reality where only the wealthy could afford to stay. And speculation about the future ran rampant. Would the market eventually recover, or was this the beginning of a permanent transformation? Some economists predicted a slow rebound as distressed buildings were stabilized or redeveloped, but others warned that the combination of regulatory deadlines, insurance withdrawals, and financing freezes could leave thousands of units unsellable for years to come. The only certainty was uncertainty. As the market continued its downward spiral, the sense of anxiety and frustration grew. Owners gathered in community rooms and lobbies, trading stories of failed sales, denied loans, and the endless search for relief. The old rules no longer applied, and the path forward was anything but clear. The market freefall was more than just a financial crisis. It was a reckoning for an entire way of life, forcing Florida to confront the true cost of its coastal dream. And as the crisis deepened, revealed, the next chapter would reveal how legal gridlock and political stalemate left owners and entire communities waiting for help that never seemed to come. Trapped in a system with no easy way out, Personal stories behind every headline about Florida's condo crisis. There's a real person living through the fallout. Someone who never imagined their home would become a source of daily anxiety, or that the dream they worked for their entire life could unravel so quickly. The numbers are staggering, but it's the personal stories that reveal the true cost of this disaster. These are the voices of the crisis retirees, families, and longtime residents, each facing a different version of the same nightmare. Take Maria, for example. She moved to Naples in 2009, drawn by the promise of a peaceful retirement near the water. Her condo at Seagate East was modest but perfect, a place where she could enjoy the sunshine, tend to her small garden, and live out her golden years in comfort. For years, Maria's life was simple and predictable. She budgeted carefully, relying on her Social Security and a small pension to cover groceries, medicine, and the occasional treat. But in February 2025, everything changed. The association delivered a letter demanding $120,000, her share of the structural repairs, a new roof, and the reserve funding now required by law. The board's minutes showed heated debate over payment plans, with some owners pleading for a 7-year option, veiled. But lenders warned that would trigger financing problems, and the proposal was rejected. Maria's fixed income couldn't stretch to cover a 6-figure bill. She tried to sell, but buyers vanished as soon as they saw the assessment. "I've started skipping meals," she wrote in an email to the board. Revealed, "I don't know what else to cut." The retirement she'd worked so hard for was slipping away, replaced by stress, uncertainty, and a growing sense of isolation. James's story is different, but the ending is just as bleak. He lives in Harbor View South, a 1981 tower in Fort Lauderdale. In March, the board split 4-3 over an 18-mile AORS Tarara Taleo million restoration plan, 95,000 per unit. The lowest contractor bid still left some owners facing more than their condos were worth. Board records document resignations and threats of lawsuits. When insurance flagged structural hazards, the building's master policy was set to expire. By August, county officials declared 13 units uninhabitable, ordering families to leave until repairs began. James watched neighbors pack up, not knowing if they'd ever return. The hallways grew quieter. The sense of community faded, and the building he once loved became a place of uncertainty and fear. "We're all just waiting for the next shoe to drop," he told a local reporter. "No one knows what's coming next, and no one feels safe." Then there's Elena, whose story unfolds at Atlantica, a 200-unit building in Miami Beach. For years, Elena felt secure. She'd paid off her mortgage, kept up with her HOA fees, and never missed a board meeting. But in July, revealed, Suncoast Mutual canceled the master insurance policy after reinsurers reviewed the latest inspection. Within days, residents received 72-hour eviction notices. Elena, who had always prided herself on her independence, suddenly faced a $92,000 assessment and no way to finance a replacement home. The elevators failed. The roof leaked, and mold crept down the hallways. "We're trapped," she told a reporter. "No one will buy, no one will lend, and all anyone talks about are lawyers and bankruptcy." The building that once felt like a sanctuary now felt like a prison. Veiled in Elena's future, once so certain, was now clouded by doubt. These stories are not isolated. Across Florida's coastline, the burden of the condo crisis falls hardest on retirees and middle-class families. Many paid cash for their homes years ago, drawn by the promise of affordable living and ocean views. Now, faced with 6-figure special assessments and insurance premiums that rival annual incomes, these owners find themselves locked in a financial trap. Most live on fixed incomes, Social Security, modest pensions, or savings that were never meant to cover emergency bills of $50,000, $100,000 or more. For some, the condo was their only major asset, bought for $200,000 or less in the 2000s with no mortgage and the hope of aging in place. That security has vanished. The reality is stark. Selling isn't an option when buyers won't touch units burdened by massive pending assessments or uncertain repair costs. Foreclosure looms for those who can't pay, but walking away means losing everything. In buildings where owners have fled or defaulted, those left behind shoulder an even bigger share of the costs. Monthly HOA fees double or triple while basic maintenance slips. Elevators break down, roofs leak, and common areas grow shabby as reserves dry up. Residents gather in lobbies and laundry rooms, trading stories of skipped meals and canceled trips. The dream of a quiet retirement by the sea has given way to anxiety, isolation, and a sense of being forgotten. What was once a symbol of middle-class stability is now a source of daily stress with no easy way out. Association boards across Florida now operate in a legal minefield. Every decision, how much to assess, when to collect, what to repair first, carries the risk of lawsuits from owners on one side and regulatory penalties on the other. The statutes spell out a duty. The board members must act in the best interest of the association, maintain the building's safety, and follow the new reserve laws to the letter. But with so many owners unable to pay and every option unpopular, boards are caught between financial ruin and legal exposure. Veiled meetings often dissolve into shouting matches over assessment fairness, payment timelines, and whether repairs can be delayed. Veal minutes from recent board sessions in Miami Beach and Naples record threats of recall elections, resignations, and even restraining orders. Some owners allege breach of fiduciary duty, filing complaints that boards acted without proper notice or transparency. Others accuse boards of acting too slowly, pushing for emergency action to avoid condemnation. Condo Association attorney Mark Feldman describes the dilemma if the board underassesses. They risk a lawsuit for failing to protect the building. If they over-assess, they risk bankrupting owners and getting sued for financial hardship. There's no safe path. Every board is one vote away from litigation. Court dockets show a surge in filings, owners challenging assessments, contesting election results, or seeking injunctions to halt repairs. Some buildings now spend more on legal fees than on actual maintenance. The regulatory reforms designed to enforce safety have triggered a wave of procedural gridlock, leaving boards paralyzed and buildings in limbo. The emotional toll is just as severe as the financial one. Residents who once looked forward to community events and friendly gatherings now avoid the common areas, wary of running into neighbors who might be struggling even more. The sense of community that once defined these buildings has been replaced by suspicion, frustration, and a shared sense of loss. For many, the hardest part isn't the money, it's the feeling that they've been abandoned, left to navigate an impossible situation with no help in sight. And yet, through all the hardship, there are moments of resilience. Some owners band together, forming support groups to share resources and advice. Others volunteer to help neighbors who are struggling, delivering groceries or organizing rides to doctor's appointments. In the face of overwhelming odds, the spirit of community endures, even if it's battered and bruised. These personal stories are a stark reminder that the condo crisis isn't just about buildings or budgets. It's about people. It's about the lives appended, the dreams deferred, and the futures put on hold. As the crisis drags on, the question remains, will relief ever come? Or will these stories become the new normal for Florida's coastline? For now, thousands of owners wait, hoping for a solution that seems just out of reach, and wondering how much more they can endure.